Hello and welcome to our continuing session on risk and returns, where we look at expectations with betas and the implications of diversification. The name is Dr. Vera Fiador. Now, at the end of the session, we would expect students to be able to know how to calculate expected returns, which are also the equivalent of average returns, but here we incorporate probabilities, how to calculate covariances, correlations, and betas, and understand how diversification affects the risk and return profile of an investment portfolio, understand the principle of systematic risk and also the security market line, and then the risk-return trade-off and how that plays out in decision making, and also be able to use the capital asset pricing model. So our basic chapter outline will be to look at the expected return variances and covariances. We want to look at the return and risk for portfolios, look at how diversification feeds in, and we'll take an example on that one. And then we're going to look at the capital asset pricing model, shortly referred to as a CAPM. So now, take an example where we have a too risky asset world. Now, there's an estimation that there's a 1/3 chance that the economy may go into a recession, be normal, or boom, meaning that the probability of a recession occurring is about 33.3%. The probability that the economy will stay normal is also 33.3%, and the probability that the economy may boom is 33.3%. Now, bear in mind that these probabilities may actually vary. They are not always static. And then they should always add up to 100% or 1. Now, in the event that the economy goes into recession, per annum, the stock fund will return -7%. Should it actually be normal, the stock fund will return 12%. And should the economy boom, the stock fund is going to return 28%. Now, it so happens also that for the bond fund, should the economy go into recession, it's going to make 17%. If it stays normal, it's 7%. And should it boom, this is going to make a -3%. So now, in order to be able to know what the average return for the year is going to be, we're going to factor in the expectations to arrive at that. So then, we're going to have a case where for the rate of return on the stock fund, we're going to have -0.7 multiplied by the probability plus the 12% also multiplied by the probability of the normal scenario, and 28% multiplied by the probability of the economy booming. So when we sum that up, our expected return is going to be 11%. And then we proceed with understanding from the computation of variances, and then we're going to square those and arrive at the variance, and then take the square root to arrive at the standard deviation. So we apply the same principle. So what it means is that in terms of the average return, this is what we have: 1/3 times that plus 1/3 times that plus 1/3 times that. That gives us the expected return on the stock fund of 11% captured accordingly. And then we do the relevant variances, and then we arrive at the sum of the variance to take the square root of that. Now, once we do the adjustments accordingly, this is what we have, because to arrive at the variances accordingly as well, you would need to incorporate the probability. So this is what we have here, adjusted to reflect the probability. So that gives us this value, and then we proceed to take the square root, and like I indicated, this is what we have as the standard deviation. We do the same in principle for the bond fund. Now, once we are able to determine the standard deviation of the two investments, then we can take some informed decisions as to the outcome. But in some cases, if you intend to merge the two, you want to have a fair understanding of how they relate to each other. Now, in terms of portfolio formation, how stocks or how bonds or how any two investments relates to each other could actually influence how the total outcome of your combined portfolio would work out, where your portfolio is a combination of assets to form one complete basket. So we can say that the portfolio is a basket of investments. Now, if you look at how the two relates to each other, then you come across the concept of what we call covariance, how they vary about each other. And so then what we do is to look at the deviations about each of them, and then we take the product of that, and then once we weight them with the relevant probability for each of the respective scenarios occurring, we are going to have the sum to give us the covariance. Now, in terms of the covariance and its value, it is not necessarily for the units to be determined as being in percentages, but the value of the covariance has to do more with a mathematical sign. So in this particular example, with our mathematical sign, we realize that these two investments have a negative or inverse relationship. What it means is that as one is improving under a particular scenario, the other may be experiencing depreciation in terms of its returns. And that is very relevant when we are going to take investment decisions. We'll get to understand how that plays out. So then the play out then is, how do we incorporate the covariance? Now the covariance becomes very relevant when we want to compute what we call the correlation coefficient, normally referred to as rho. Now with the covariance, you're going to take the covariance and divide that by the product of the standard deviations of the two assets that you are comparing. Now that gives you a correlation coefficient that will range between -1 to +1. So correlation coefficients must always range between -1 to a +1. It should not exceed. Now, the closer the value is to a unitary point, whether -1 or not, or positive, we refer to that closely as perfect correlation. But in this case, where the sign is negative, we say that they are perfectly negatively correlated if the value is an absolute 1. Now, on the other hand, if it's a positive value, then we are looking at a positively or perfectly positively correlated relationship. Now, in this case, where the relationship is a perfect case, then we mean we have a 1-to-1 mapping, and if it's in a positive case, it means that they are directly related. When there's an increment in one, there's an equal increment in the other. And when it is negative and but perfectly correlated, it means that when there's a drop in one, there's an equivalent appreciation in the return of the other. Now, this relationship, like I mentioned earlier, is very relevant in putting together portfolios. Now, if we look back to our example, we can see that the standard deviation for the stock seems to be higher than that for the bond. Now, let's look at a case where we decide to invest 50% of our money in the stocks and then 50% of our money in the bonds. Once we do that, our expected return, which is the weighted return of the two investments, is pegged at 9. And so then the variance for that also drops and the standard deviation also drops. Now, this intrinsically brings to the fact that we have the impact of diversification at work here. So then, look once again at the expected rate of return on the portfolio, which is the average of the expected returns of the individual securities that make up. So where WB captures the weight that we have in the bond portfolio, and then WS captures the weight that we have in the stock fund. Now, when you put the two together, that gives us a portfolio. So we have the expected return on the portfolio, and this is proxied by 9%. Now, when it comes to the variance, this is captured by the formula here, which is normally arrived at using a 2-by-2 matrix. So here we have realized that the correlation coefficient is also captured here. Now, if you look at the fact that this second segment of the equation is a complete product along the line, this is where the role of the correlation coefficient places best. Now, by virtue of diversification, the risk profile in general of the portfolio drops. Now, how far it drops, maintains, or goes up a bit depends on the correlation that runs between the two or the assets that form the portfolio. Now, in the event that the correlation coefficient is negative, because this is a whole product segment, we are going to have this value becoming negative, meaning that for in a two-set investment that have negative correlation, the risk profile, the variance drops significantly. On the other hand, even though risk will drop clearly because we have diversified, the volume is not as great if they are positively correlated, because this whole value would add on to the base risk we enjoyed by virtue of diversification. If, on the other hand, the value is 0, then it means that without the correlation, we are left with the base risk by virtue of diversification. Now, let's look at the fact that by virtue of diversification, we observe a decrease in risk. For each of them, we had 14.31 and 8.16 for the bond fund, but once we put them together, the portfolio has a standard deviation of 3.08. But if you look at the significant drop in risk, it doesn't necessarily match up to that much of a significant drop in return. So diversification can give you the opportunity of dropping risk without necessarily losing so much in terms of portfolio returns. Now let's look at this combination. Over the full combination set for these two, we can see that when we have 0% in stocks and therefore 100% in bonds, the risk is 8.2, the return is the return on the bonds average, which is 7%. Now, as we keep on increasing the investment in stocks and therefore decreasing the investment in bonds, we can see our return rising on, and even then the risk actually dropping. Now, once the risk drops, we begin to get to the point where at 50% combination, that's what we have, standard deviation or risk profile of 3.08 with a return of 9. So normally we would continue to do the mix and match until we get to a point where we arrive at the least point risk, and that may be the point where we decide to settle on the combination. Now, typically, by plotting the combination set that we got from this point, we can see that for the same level of risk mapping to returns, we can see that for the same level of risk of 2, we have one portfolio here and we can have one portfolio up here. Now, if we are to take on the same set of risk and we can make there about 8% or 9%, obviously the rational or the prudent investor should go for the higher rate of return for the same level of risk. At this point, therefore, we have a combination that we refer to as the efficient set, because then for those combinations, they offer better returns compared to their counterparts that fall below, which offer not the best of returns, but also carry the same level of risk. And so that's the case of having better investments with the top set as compared to the lower set. And so this constitutes what we'll call our efficient set. And so in the investment selection process, your focus will be on what makes up your efficient set and not just any combination. Now, let's look closely at diversification. Now, diversification can significantly reduce the variability of returns without necessarily causing an equivalent reduction in expected return. For this reason, the risk reduction arises because worse than expected returns from one asset can be and are usually offset by better than expected returns from another. Now, of course, there is a minimum level of risk that cannot be diversified away, and this is normally referred to as systematic risk. In the layman's term, you can say that it is with a system. So it doesn't matter whether you move from one project to the other, you are still stuck with a systematic risk. And so we refer to the fact that that is not diversifiable. So another name for it is market risk. It is with a market, it is with a system, and you cannot diversify. Meaning that when you move investments across a series of other assets, it will not necessarily disappear. Now, on the other hand, we have diversifiable risk, non-systematic risk, firm-specific or asset-specific risk, or unique risk. Now, this is tied to a particular asset. So the more you diversify or the more you spread your monetary investments across a number of assets, the more you do away with this particular kind of risk, and then it gives you the opportunity to make better returns. Now, systematic risk normally affects quite a large number of assets, as indicated earlier. It affects the system, and for that reason, it's not really diversifiable, meaning you cannot necessarily do away with that. And it normally emanates from such things as GDP, inflation, increases in interest rates, or changes in interest rate. Now, this has to do with an economic system. And so then, being in the economic system exposes an investment to such. On the other hand, diversifiable risk is limited to a number of assets. It's specific, and it flows from unique situations that may be specific to a firm, and that could be labor strikes, parts or shortages, and others. That is more specific to a firm. So when you invest away from such a situation, you are less prone to such, and for which reason it's considered diversifiable. Now, once you begin to combine the assets within a portfolio, you begin to do away with this unsystematic risk. And so if you hold on to only one asset or assets in the same industry, then intrinsically you are exposing yourselves to risk that you could diversify away. So now let's look at how the whole concept of risk therefore is captured. So total risk, which is normally captured by the standard deviation, can then be seen as being made up of the systematic portion and the unsystematic portion. And as you begin to diversify, the unsystematic portion becomes very small, quite negligible, so that when you have a well-diversified portfolio, typically the risk profile of that can be likened to the systematic risk, which is normally captured by the terminology beta. So that an investment that is found in a well-diversified portfolio is only with a risk profile or with a risk measure for beta. It hasn't got unsystematic risk embedded in there. Now, therefore, beta typically looks at how responsive a market, the returns of a particular asset are to the movements within the market portfolio or within the economy. And so this is how it's captured. The beta of a stock or any investment is captured as the covariance between that investment's return and the market return. So that's the covariance, as we did, so how the two vary about each other, divided by the variance of the market. In this case, the typical product or standard deviation twice. So that's the square of the standard deviation for the market. And so when we estimate the pathway of how a particular security behaves in relation to changes in market situations, then we capture the beta of that particular. So that's a slope to capture the changes that we see. And so that's typically what we refer to as the beta. And so we're back to the formula. So clearly your estimate of beta will determine on your choice of a proxy for what reflects your market portfolio. Now, how do we incorporate this? Now, CAPM says that if you can truly do away with the unsystematic portion, then we could only compensate the prudent investor who is able to do away with the unsystematic portion of the risk within an investment. So to arrive on that, they estimate that the return on a market portfolio, that is a well-diversified portfolio, is the base risk-free rate that is usually proxied by government treasury securities plus a market premium, where the market premium is the extra compensation that you earn when you invest in risky assets. So in this case, the portfolio of risky assets, the average return on the portfolio of a risky asset less the return of the risk-free rate usually gives you the market risk premium. And so the market return captures that as being the base. So for any investment that is risky, typically, you have to earn the risk-free rate and then the premium. But in this case, if you're looking at the market return, then it means that we are looking at the risk-free rate plus the market risk premium. So when we transmit that onto individual securities, then it so means that once we are able to determine the risk, we know the risk-free rates, we know the beta of an individual security, then it means that once we know the market risk premium, which I already indicated as the difference between the market return and the risk-free rate, the product of that will give us the risk premium to be earned on an individual security, added to the base rate from the risk-free, gives us the expected return on the security, an individual security. For this reason, this is what CAPM says should be our portion when we are prudent in investing and therefore diversifying appropriately and doing away with diversifiable risk. So this is what we have as our market premium and then the beta. And then once we have that put together, we know the expected return we should make on a security that is in a well-diversified portfolio. So this is the basic formula for the CAPM that captures it accordingly. Now, in an efficient market, therefore, all securities should typically obey the CAPM rule, meaning that their expected return should be a function of the risk-free rate and the risk profile factored into the average market premium. And so that in an efficient market, all securities should fall on this line, which we refer to as the security market line. Now, with the security market line, therefore, what it means is that we can see that at this point where risk is zero, we have the risk-free rates, typically reflecting investments that are riskless. That's like T-bills and typical government treasury facilities. Now, any other investment that begins to have systematic risk will then fall here in adjustment to the risk-return trade-off that has been established within the market. So here we have the relationship being mapped so that return on security I, given a base risk-free rate of 3.0, and for security I, which has a beta of 1.5, when we adjust and we get the market risk premium, which is the difference between the market return and the risk-free rate, our expected return should be 13.5. Intrinsically, it means that for the fact that this security should or is making more than the market is making, it presupposes that it has a higher risk profile compared to the market. And truly, the market risk or the market beta is typically proxied as 1. So that's the base, and all others in relation to that. So entities or securities that are more sensitive to the market have values greater than 1, and those that are not as sensitive may have values of beta less than 1. So then we need to understand some basics that we could always examine returns on the financial markets to help us determine the appropriate returns for other non-financial assets. And then know that there's always a reward for bearing risk. The greater the potential reward, the greater the risk, and this is normally the risk-return trade-off. Now, some questions to go home with. How do you compute the expected return and standard deviation for an individual asset? And what about a portfolio? Is there any difference between systematic risk and unsystematic risk? And what type of risk is relevant for determining expected returns, if any? and then look at a case where you consider an asset with a beta of 1.2, a risk-free rate of 5%, and a market return of 13%. What will be its expected return? Thank you, and see you in the next session.